Hello everyone. I just wanted to make a quick video about Twitter. Everybody's been talking about earnings coming up and Jack coming back as the CEO for Twitter. So I just wanted to take a look at the options and see what the market's saying. So let's come over and we're going to take a look at the trade page. And here I've just pulled up the different strikes for the next coming months. So you can see in November, what we want to take a look at is going to be the implied volatility and the probability of the out of money. So taking a look at implied volatility, what we're going to look at is the difference in implied vol between the call side and the put side. So the market's just joking. So we're going to take a look at the difference in the volatility between the calls and the upside. So right now you can see that the call side has much more implied volatility than the put side. This means that market makers are pricing in a bigger move to the upside. This is at least in 30 days. As we get further away, you can see that the at the money strike, and so if it goes like 2 or 3 strikes away, you can see that got 69 here for the call side and 63 here for the put side. So there's a big difference between the implied volatility in the calls and the puts. The market makers are pricing in a premium for the calls because they expect Twitter to rebound in some respect, at least in some respect. How far it's supposed to go, we can take a look over here and see expected move. Right now, at least 90 days away, it's about a 7-point move up and down. If we go further away, you can see this a bit more. So in the June 16, which is almost 240 days away, you can see that the implied volatility for the 3 strikes out of the money, or 3 strikes out of the money is going to be 51 on this side, and then 51.30 on the other side. So there's much higher implied volatility because the market makers are expecting Twitter to rally and head back up. And let me see if I can pull up options. We're going to take a look at implied vol. Let's get rid of the nearest weeklies and just take a look at the monthlies. Right. So there's a lot going on because of earnings right now and some other Jack coming back to the company. So there's a lot of volatility in the market. But you can see that the curve is really quite messed up right now. So the implied volatility for the puts looks pretty good, but on the call side, you can see that the near at the money is going to be much higher than the out of money. There's actually this dip between 40 and 45. So there's a lot of pricing in going right now for the at the money calls because I believe they are expecting a rebound. If we take a look at the chart, you can see that. Let's go to the weekly. So you can see this weekly, and there's been a downtrend pretty much for the past few years, in several months. Okay, so it's been a downtrend since the IPO. Twitter hasn't really been able to have any good earnings. I've seen only one time when they've been able to get in double digits in earnings per share. And coming into this earnings season, I think it's going to be pretty weak as well too, until Jack's going to be able to come in and really take a good look at the company and hopefully turn it around. Personally, I don't think Twitter can ever do anything. They're a microblogging site. They have low numbers, and it's just not my thing. But I think it's the MySpace of the next generation. But we'll take a look. Take a look at the options. There has been a turnaround recently. You can see that there's a bit of a inverse head and shoulders here, so we could see some up movement in Larry Sherman, possibly coming back up to around 35 now that Jack's back. All right, Sam from Traders Insight. Take care.